y'all? What's up, y'all? Y'all thought we left y'all?
We back.
It's back. It's 2021.
Okay.
We get had a little hiatus, kind of let every stuff settle and everything, you know. And we gave y'all some games, showed y'all the workshop bits and stuff, and we hope y'all took advantage of that information.
Exactly.
But we is back.
We's back, y'all. We back, y'all.
I am Red.
And this is Shay.
And this is Ebonic Economics. Money talk in our language. Hello.
In today's episode, we are going to go through the process of buying a house.
Woo!
Top to bottom. We're going to try to cram this in this little episode and go over a couple of things. Yeah.
We can do it.
We can do it, yeah. So, the first step to buying a house is your credit, right? Your credit. You get approved by a lender. Now, don't get scared. You can do what's called a FHA loan or what's called a conventional loan. So, an FHA loan is backed by the federal government. It's a federal loan. And with that loan, you only need a 580 credit score to get approved for that loan. A 580 credit score and about 3.5% down. That's it.
Percent of the cost of the house.
Percent of the cost of the house, which I'm going to go over examples of that as well. How much you can use. Like for a $300,000 house, if you have about $9,000,
you can do that.
You can do that.
But if you find a $300,000 house in LA, call me.
Yes. Yes, you can negotiate.
Corona, you'll be right.
Yeah. But with a conventional loan, you need about let me make sure because I got 620. 620 credit score. That's the lowest they'll go with a 5% down payment.
Wow.
So your credit score has to be higher, and so does your down payment.
Well, that's really good to know because a lot of us think that we have to have perfect credit to get a home or we got to have a 750 FICO. And while that would be better for you in a borrowing situation, it's not the requirement. So you might qualify today to get out of where you are and get into something that you will have for the rest of your life that you can own and pass down and start some generational wealth.
Exactly. And with an FHA loan and a 580 credit score, you still can be locked into a good rate, 3, 4, 5% interest rate as well. So with an FHA backed loan, because you can get a conventional loan with an FHA backed loan, then you can still qualify for that low interest rate. So just know that. Do not be afraid of that. Don't think, oh, well, I got a 580. It's like a credit card where they're going to push your interest rate up higher. No.
Right.
It's not going to work like that. You're going to pay the rate what's going today. If the interest rate is the federal rate is 4%, it's 4%. If it's 5%, then it's going to be 5% regardless. If your credit score is 580 or 620, it's going to be the same.
It's going to be that.
You just have to get approved. And 9 times out of 10, what's going to happen is you're going to have a conventional loan and it's going to be backed by FHA loan, which is great. And it's great for these people that's going through COVID right now because they are the only ones who can put their mortgages in forbearance right now. Or the FHA backed loans. A lot of people who just have strictly conventional loans think they can. Go ahead.
I was going to say, tell people what forbearance is.
Forbearance is when you're having an issue paying your mortgage. Like right now, COVID, you can't go to work, you can't do that. You can put your loan on what's called a forbearance, where they will hold off your payments and you don't have to pay them. And it's not looked upon against you. It doesn't go against your credit. It's just on hold. It's on freeze. You don't have to pay late payments. You don't have to do any of that. Now with
interest?
No. Now, what you do have to do in certain instances on forbearances, typically if you have your home in forbearance for 5 months, right? And your mortgage is say $1,000 a month for the sake of numbers. And on that 5th month, they will expect their $5,000. However, let me help you. However, and this is if it's not an FHA loan. If it's an FHA back, you would take it from forbearance and you would do what's called a deferment. So you will not have to pay that $5,000 in the same day.
Until later.
They
That's
they
like-
defer it. They'll put it on what is called the back end of your loan.
That's like deferred sentence. If you get caught up, you get deferred or suspended. Deferred just says, you know what, it's going. You got all this time to get it right, and then later at the end of that, we'll do this.
We'll deal with it.
But deferred.
Yeah, so you could get a forbearance, and then that if you have that $5,000 the day that your forbearance is up, if you don't, you would do what's called a defer. Okay?
Okay.
But FHA backed loans allow you to do that.
Yeah.
Okay.
Okay. But
Okay.
a conventional loan that is not backed by the FHA will not allow you to do that.
Exactly. Well, they may let you do that forbearance.
They might have the.
But you best believe that deferment part
it's
of it,
not happening.
that's the part. Okay. Oh, you can forbear.
You're gonna go from forbear to foreclose.
And that's how we about to get a lot of these houses during COVID.
Yeah.
Because some people didn't get that.
Awesome.
They didn't realize that they are not FHA backed. Therefore, that CARES Act and all that did not apply to you. So it's great to have an FHA backed loan. You can make a lot of money and still have FHA backed loans, and you can buy an FHA home, which we'll go over that later. So once you do that, you'll get what's called a pre-approval letter.
Yes.
And you'll be able to go and you'll be able to go look for you a house with this letter. You will take this letter to your real estate agent and you'll say, hey, look, they approved me for, and based on, hold on, how much money you make, etc. They're going to say, okay, this is how much, what you told them on surface. They're not going to dig deep. So if you lied to them when it's time to close, they'll deal with that later. But right when they do a pre-qualification, you just tell them, this is what I have, this is what my credit is, and this is how much I make. Based on that one form, because you'll fill out a one form document, they'll say, based on what you told us, you would qualify for
This amount.
this amount. And from that amount, you would then go start to look for your house. Now, this is where I want to kind of help y'all out with this down payment, this 3%. Because, you know, $300,000, well, you can move to like San Bernardino,
Right.
Riverside,
Somewhere.
Moreno Valley.
Yeah, but if it's a $500,000 in the city, you're looking at 3% of that is $15,000.
$15,000 down. However, do not get afraid. Now, if you have $10,000 right now, remember you're only going to get a pre-qualification letter. And this is my process. I'm telling you this because this is the process I did. I didn't have all my money. I didn't have all my down payment. I got my pre-qualification letter because from there, all you're going to do is start looking.
Mm-hmm.
You don't have a house tomorrow. You know what I'm saying? Like, so.
I mean, unless you just work
Unless
like
you
that.
just, you know what I'm saying? So
yeah.
as those months go and you're starting to look for your home, you're still saving now, right? You still saving your money.
Budgeting.
You should be, yeah. Like, so you
Working
should
toward that goal.
And even up until closing, because you do not give them that money until you close.
Okay.
So if it take you 6 months to find a house and you in a 90-day close, you have 9 more months to come up with that down payment. All you need to do to start the house is you give them what's called a good faith down payment, which is good giving back to you later on.
Mm-hmm.
Okay.
Good faith.
It's called a good faith. When you make an offer, something baby want you to do that shit to make sure that you ain't just out here window
Bidding
shopping.
up, yeah.
Okay, just window shopping for bullshit. So that's simple. 580 credit score, a 620 credit score. Now, once you get into the process, I want to go over now. Hold on. Before I go, PMI.
PMI.
PMI. Now, when you only put 3% or 5% down on a loan, you will pay what's called PMI, which is property mortgage insurance. If you put anything less than 20% down on a mortgage, you will have to pay PMI.
Mm-hmm.
There's programs that can help you get past that. We'll talk about those later. But PMI.
Okay, and I was just going to say, basically, that's just payment protection for the mortgage company.
Exactly.
You're going to be paying them probably $700 to $900 to $1,000 depending on the amount of your mortgage extra. It has nothing to do with going toward the principal price of your home. This money does not lower the amount you're owing on the house. This is money that is going out of your pocket down the drain to these people, and you're giving it to them to say, hey, if something happens to me,
My
mortgage will be protected because I'm double paying this shit
Yeah.
basically. But it ain't gonna go into effect unless something happens to you.
Exactly.
If nothing happens to you, it's down that drain. It's not. They're not putting it over here in a nest egg or none of that. They just saying, "No, you got mortgage insurance, so if you get sick or something happens, you don't have your income. We're gonna cover it for a while.
Yeah.
For a while,
For
not
a while.
for the remainder of the loan. For a while.
Exactly.
That's all.
That's property mortgage insurance, and if you can avoid that. So of course, and I know you're like 20%. I'm gonna avoid that. Put 20% down. There's programs, and I'm gonna go over that with you that'll help you with that 20% down, which can be a separate loan, and I'll talk to you about that later. So what they're looking for in order to close. So what I'm gonna talk to you about is in order to close. You look for your house, you found it, hopefully you check your water, you check, your plumbing, all that. Please check that. My son at the time was 6 or 7 years old. He checked the water. I was just looking at pretty houses. He was like, "Mama, but the water don't work." And I was like, "Oh,
yeah,
the water pressure."
That's a problem. Yeah.
So he made me check water pressure every house I went to from there because I wasn't thinking like that. So when you make an offer on a house, does not necessarily mean you'll get the house or you will go through close. Your offer can be denied.
Mm-hmm.
That's number one. You can love the house.
Somebody might come with a better offer.
Somebody may come with a better offer, or they're just looking. People can deny your offer just because they want a particular person. Initially, I was denied an offer on my house because they wanted a family, and it was just me and my son. They wanted to rent it.
Nuclear.
They wanted to sell it to somebody who had a big family. I didn't. They came back. And I negotiated. I told you about that lady. You negotiate was You shouldn't have came back. They paid the clothes and all that. But anyway, they shouldn't have came back. But you can't have your offer denied for a number of reasons. They do not. One thing about home buying is they don't have to sell you their house.
Period.
They don't. Just because you make an offer.
We reserve the right to refuse service to anyone.
Mm-hmm.
This is my shit I'm selling. If I don't want to
Even if
sell
you qualify, you got the money.
Now the bank can't discriminate against
the bank
you
can't
give you the money, but the homeowner, oh yeah,
can say no. They can deny it. They can say I don't want to sell to this person, or you can't close. Now let's go over things that will help you close because people can get all the way to that point, and that's what happened in my house. They couldn't close. The people that they did accept couldn't close the deal. Because you still have to close the deal.
Period.
And one of the main things is work history.
Mm-hmm.
They're going to want to make sure that you have at least, and believe this, 6 months to a year.
Okay.
Consistent work history. That's it. That you've been on your job 6
not
months
10
to a year.
years.
Not 10 years, not 15 years. And I'm going to also share something with you is when I put the offer in on my house, I quit my job. And I tried to take my offer back. But my agent taught me that no, just because you quit your job, as long as you have another one put in place, we can continue on with this deal. And that's what we did. Okay. And we closed it. But just so you know, that's an option because I was in a situation. I was a manager and I was going to kick this lady's ass.
I told y'all sound like people.
I was like, fuck this house. I quit.
I'll do it later.
I'll do it another time. I was there. But my agent showed me that you could still do that. So just so you know, if you just left your job or if you was laid off and you're in the middle of closing, you can still close the deal.
You can still close the deal. Okay.
So 6 months to a year employment. But the most important, and a lot of people don't understand it, is rental history. Mm-hmm. They don't take receipts anymore. They're not going to take handwritten receipts, your cousin and Rosa receipts. They need to see that you pay consistent rent from your bank account, not even money orders.
Right. Because if you ain't got no bank account, then you ain't supposed to get no mortgage. There's a problem there. So
trick to people who living with their mothers are, and this is how a lot of our other Hispanic brothers and sisters do it, because you think you have to get out and live on your own and we all want to separate the household and all this. No, You can live in your mother's room, next extra bedroom, and she charges you $200 a month They don't care how much your rent is. They just want to make sure that you pay it consistently.
The consistency is.
It's the consistency.
Are you responsible and consistent and able?
Thank you. I heard a woo. I thought she
Yeah.
about to. I'm like, she about to preach on. I heard a woo. I was like,
No,
what the shit?
I'm just saying, because again, and that's something that they look on your credit report too.
Mhm.
That information is also on your credit report. That's why your score has to be X number of points or whatever. Because listen, consistency is lifelong. That's throughout.
Yes,
From the
no.
time you get started really doing something to the time you leave here, one thing you need to carry with you the whole time is consistency.
Be
Period.
consistent all the time. And that's all they look for. So if you rent your mom's room, what you need to start doing is paying her checks. Paying her checks every month. $100 checks, $200 checks. Pay her checks. Now you can do cashier's checks from your bank account.
From the bank, yes.
So you can do that. And let me tell you something, pay it on the same day.
Mm-hmm.
Because what they will do in closing is if you pay it on the 3rd, the 5th, you're going to have to write them a letter and explain to them why on this particular day you paid it on the 5th.
Wow. They all in your business.
They in your business.
Mm-hmm.
Okay, you're going to have to
Wow.
explain to them. They're going to know why you're not paying it on the 1st, why you paying it on this day. So if you could just pay your rent on the 1st every month consistently for the next 6 months, that's because they're only going to go back 6-month rental history.
Okay.
So if you want to start doing that now, if you want to buy a house, pay your mom, your neighbor, your girlfriend, whoever your rent. Don't give them the cash, because if you say, well, I've been paying her cash and then she my roommate and then look at her bank, they're not taking that.
Period.
They're not going to take her bank account unless she's going on your loan.
You need to have established your own history.
Yeah, your own history. So you need to have some checks written to her, and that's key. Because if you don't have that, it's not going to close. That you think that's small, you think it's simple, they not closing you.
Yeah. Nope.
They're not closing you. They don't want no letters. The next thing is, like we said, the down payment. So you got to have that 3%, that 3.5% down. And that 20%, we'll go over that. But the other thing to close is the home buying certificate in the state of California. Some other states require this as well. It's called a home buying certificate. It's an 8-hour class. It's about $60. You have to sit there and they go over all these things that I'm telling you in detail. They go over how to take care of your house, what to expect, that you are no longer a renter. If you have plumbing issues, those are your issues. If you have electrical issues, those are your issues. So they basically teach
You the landlord.
You the
Ain't
landlord.
no more calling nobody. You gotta look at yourself in the mirror and say,
Mhm.
how am I gonna fix this?
Exactly. And as a first-time home owner, you can also buy a multi-family unit up to 3 or 4 plex. You can purchase that because you can live in one and you can rent the other. That's a different kind of class though. So you would make sure if you looking to buy a multi-family unit, you have to take that course, because that course, of course, is going to go over renters and what you are responsible for. So that's key. The escrow process. So you will do what's called open up an escrow. Once they accept everything, that good faith payment is given, it will be given to your escrow officer.
Now, sometimes during escrow, if you have bills on your credit, they negotiate. They can send a demand to your escrow company, and part of your escrow will be set aside to pay your debtors or your creditors. If you qualify for more than the value of the home, they are going to wrap those debts up into that loan for you, and that's going to help you. Yeah.
You definitely can do that, because some people you get approved for a certain amount, but you may get approved for $400,000 but find their miracle house for $3. You still have $100,000 that you can work with and consolidate all of your.
They're still willing to give it to you.
Yeah, they'll consolidate your credit cards, and you'll be what some people call debt free when they purchase a home. You're not really debt free because you have the home.
Now you got a new $300,000 loan.
Yeah, but you don't have those credit cards, which now you have a excellent credit score because they're being paid off.
Exactly.
So don't ever forget that. The title process. So I want to go through this process because a lot of people, this is extra money that you need on the side.
In addition to closing.
Exactly.
And down payment.
So down payment has to be earned question money. If you If your down payment is coming from your grandma gonna be questioned. Grandma gonna have to explain to us where she get this money from, why she giving it to you, all that. So it has to be unquestionable money. So if you can show where you saved this money over time,
they have to be able to trace.
They have to be able to trace where that money came from. On the flip side of that, your closing costs. Now, closing costs will be 2 to 5% of the cost of the loan, meaning not the $300,000 is whatever it is after the down payment. So if you were able to put $10,000 down, it'll be $290,000. It'll be based off of however much the loan will be.
Right.
So it'll be 3 to 5% of that, which you're looking at about another $10,000-$15,000 to close.
This is out of pocket expense.
These are out of pocket.
Prior
difference.
Yes.
With the closing costs. Let me sip on that. The difference with your closing costs, that money can come from anywhere. They don't question closing costs because guess who's getting the closing costs? The escrow company. You can pay your closing costs with a credit card. Your friend can do it. Or if you were smart, you would have negotiated it with the purchase.
Exactly.
You don't necessarily have to pay that. That's something that you can say, I want to make a full offer on a house because guess what? You're approved to do so, but I want them to pay the closing costs. Or you can say, we go 50-50 on the closing costs. That's all negotiable.
You got to say something.
You have to say something. When you're buying a house, this is when you really learn how to negotiate. Let me tell you something. The refrigerator, y'all can't see my stove, my refrigerator. I didn't pay for none of it. It was all negotiated in my mortgage. It's part of my clouds.
You know what? Okay. I'm laughing right now because I don't know, a lot of y'all may not, I don't know, but it's an old movie out there with Richard Pryor called Moving. And that shit is so fucking funny because they're looking to buy this house, and when they go and view the house, the people are like, oh, they're like, oh, we love those stairs. And the people say, ha, 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 we're taking it with us. Like, oh, they laugh it off, and they go in the kitchen like we like the pool. We like, oh, this, oh, ha, 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 oh, we're taking it with us. They laugh that shit off, but when they go back to move in that house,
shit is gone.
All that shit is gone. They really took it with them, and they agreed to that. And didn't realize they did, but it was in the paperwork.
Because you can negotiate. If you walk in a furnished house, you can make an offer on the furniture. You can say, I want everything. If I make an offer on this house, I want it to include the couch, the roof, the this, the art. You can do that. That is up to you. A lot of us think like, oh, we just bought a house and you can negotiate
everything new.
No, you can negotiate all that.
Most of the time, they don't want to take it with them no way.
Yeah.
And it looks good in there.
Yeah, they like, we don't want this TV. Yeah. So you definitely can negotiate that. So don't be afraid when you hear that closing cost, because that closing cost. Yeah. Okay, so.
Yeah, so by now you done had all that time. Come up with that closing money, that down payment money. What was you telling them?
And also, don't forget that you got to pay that, not title, but inspection.
Oh, inspection.
That inspection cost. So be aware that inspection costs, your down payment, which has to be unquestioned money, closing costs. It can come from a credit card. You can pay your closing costs with a credit card. Definitely. So don't worry about that. So you can also pay your inspection with a credit card too.
Oh wow.
If they accept credit cards.
They just want that down payment.
They just want that down payment.
They don't want no dope money. They trying to X the hustler out.
Exactly. They don't want no money that they haven't got no tax money from. Please believe that.
Right, because once you get that mortgage, then you get a tax break, but that's another episode.
That's
woo,
girl. Whole another episode.
We might do that around April 15th, around tax time.
I know.
Okay, listen, we always come up with something, but that's what it is when you want to move forward. Your brain will take you there. But yeah, so now you know the steps from A to B, A to Z. Buying, starting, getting you a home. What's the homework? You said what?
Get you a pre-qualification letter. Make sure you get your pre-qual letter.
Oh, wait. First, get your credit score.
Thank you. Okay, I was like, hold on.
You gotta know where you at so you can know how you gonna be able to play it. If it's 420,
you got work.
Which that's not a bad number. But if it's your credit score, it's terrible.
It's horrible.
Yeah, so worked on getting into that 580 for the FHA
FHA
and 620 for the conventional.
Exactly. So if you have 620, you can get a conventional backed by FHA. What?
Double bam.
Double bam. So make sure y'all do that. Don't be afraid. Do not be afraid to pay
Don't
less.
be afraid now, baby.
And not to mention our programs that we have. It's a lot of programs
that
the down payment programs, NHS LA County, NHS Orange County, NHS San Diego County. They come in different counties. There are other programs too. The reason why I say NHS, because NHS don't ask you to do the volunteering and pay that monthly. It's some programs.
And they vary from state to state.
And
those programs are California. I'm from Oklahoma, like I had said, the FHA, Future Homemakers of America. That's the program out there when Future Homeowners of America, I'm sorry. You get an FHA assistance in this. And so, but check with your state because, you know, everybody that watching us ain't in Cali, but it's a program probably
in every state.
You know, to
there
help
is
you.
A program, because my sister in Texas right now, I just had to find her estate. A program. They have a program where for people that's buying houses in like rural areas. They giving out a lot of money in Texas if you're not buying in the city. They give you a big down payment if you want to buy land. Actually, it's funny we talking about that.
Land.
If you buying land,
you want 40 acres and a mule.
So every state has a home buying program. If you want the FHA in your, because that's federal, that's all over. If you want them in your state, you have to have a home buying program. They not having it.
Period. So, you gotta help too as a state. The Fed gonna come get some money, but the state gotta be there too.
The state is gonna be there too. There's forgivable loans. Wells Fargo offers forgivable loans. They give up to $30,000 down. You just gotta live in a house for 5 years. They're called neighborhood restabilization grants.
Ooh, girl, that should cost money, right?
Okay.
We should charge for that.
She said, "Hold on."
Yeah, we should be charging for that, but we're not. We're giving that to y'all because we want you to get somewhere. This is Ebonic Economics, y'all. Money talking our language. If you didn't understand this shit, you didn't want to.
You understand it now. You gonna understand. You heard what we said. 580 credit score will get you in a house.
620, not 420. That'll get you that conventional.
620. Real quick before I leave, if you buying a home as a couple, the person with the lowest credit score is the credit score that they're gonna go with.
Wow.
They never go with the highest.
So
keep that in mind. So don't be in mind, well, I got a 7. We ain't got to worry about you. You got to,
we're going to go
they're going to go off the 5.
Yes.
They're not going to go off your 7.
Get together.
They're not going to meet in the middle.
Yeah.
They're going to go with the lowest person's credit score.
Wow.
Don't ask me why, but that's how it goes. Those are the facts.
Because they're going to be, because he's involved in the loan and we have to risk it based on his rating. Not the highest rating, but the lowest rating. Wow.
So that's why you either keep it.
And then you know what? You'll have another credit score when you go to get your credit report for a home loan.
Yes.
Because they use a different calculation to come up with your score to buy a home loan versus than they do with a credit card versus what you see on Credit Karma. Your shit on Credit Karma, I got a 5.9, I got a 630 on Credit Karma, and then they pull your shit, it's 520. Because it's something else that the other factor. So that's another day.
That's a whole another day.
Another
so homework, credit score,
and get your
and then get a pre-qual. You can go anywhere and get a pre-qualification. You can go to the nonprofit organizations that handles. You can go anywhere and get your pre-qual. Don't mean you need to get your loan with these people.
Right. Just go see what you qualify for.
Just see what you qualify.
Know where you stand. Damn it.
What was that line you say? You gotta know.
You gotta know where you at, so you can know where you can go.
There you go.
You gotta know where you at, so you can know how far you can go. What you're gonna be able to do. Of all the spots. You know, Ebonic Economics, y'all.
Money talking y'all language. We love y'all.
Yes.
Till next episode.
Yes.
Send us a message, comments, all that. You know we love y'all.
Like, share, tell somebody about it.
Yeah, subscribe. We here for you.
We about us. Don't keep us to yourself. I know you want to keep us to yourself. Share the love. Share the love. Ebonic.